NZ. Thank you for joining us. We're talking about investment properties today. We've got some of my clients here who are kindly going to share some personal experiences and give us some tips on property investment. We've got basically Les.
Hi guys.
Neil.
Hi.
Richard.
Hi.
Anna.
Hello.
And me. So I'll start off with a little bit of my own story. So I bought my first investment property quite late actually. I was a mortgage broker for many years without a property, and it started to get really embarrassing after a while. So I thought, okay, I have to buy a property. Everyone's making money out of it. It's got to be a safe bet. So bought my first investment property. Actually bought out in Hamilton. Just bought it at the valuation price, and then the market crashed straight afterwards. So that didn't look too good looking back on it. But the good thing was, I had really been looking at the cash flow side of things when I bought. So the cash flow was really good from day one, and it was actually it was really easy to hold on to even during the slump. And then after it had crashed about a year later, I thought, well, probably should buy another one to offset the stupid move I made buying at the peak. And so I did that, but again, because cash flow was really good, it meant that the next 6-7 years of a completely dead flat Hamilton market, I was never having to, never really thinking of selling. The rents just kept going up. So that was really good. So I guess my first tip would be really learn about, well, for me, property investment is more about inflation and what inflation does to debt. And over the long term. So for me, property investment has been, about the rent, what kind of rent I'm getting from day one. I guess the biggest tip will be learn about inflation, learn about the effect of inflation on debt, and the effects of inflation on rent and other things. That would be important. The last couple of years, it's been harder to get yield, good rental yield in Auckland, so I've been looking outside of Auckland in places like Hawke's Bay, Rotorua, and what I found is some good yields out there. Like 2 years ago, you could buy a property and then 7% of that purchase price you would get as a rent every year. Now it's probably down to 6% in some of those smaller towns, but it's still good buying. That's not to say that Auckland doesn't have its opportunities. I think there's some great things happening now, big opportunities with, I think the big opportunities lies in the fact that not everybody is clued up with things like the unitary plan, and I think the new tunnel going to town, I think the way that traffic's changed, I don't think everyone's really let that sink in and what it's meant for properties. So I think those two things are really important to think about as well if you're looking at Auckland. But I'll hand you over now to Les, who works for Barfoot and has also been in the property game for a long time. So, Les.
Well, good evening. Hamish has just mentioned Barfoot and Thompson, but I'm not going to talk to you about my experiences as a salesperson as much as my experiences as an investor. Now, over the last 20 years, I've been a small-time property investor, and here we're talking residential property only. We're not going to be talking about commercial property. You go to some seminars and people talk about having a business plan. Now, I am not a person who believes in detailed business planning at all. In fact, my plan in mind was simply from 20 years ago to try and achieve a passive income by the time I retire that would give me a more than adequate replacement, if you like, of superannuation from the government. And I think I've achieved that pretty much now over the last 20 years through residential property investment. So my plan at the time was to say, let's have a passive income of approximately $100,000 per year without any mortgages to repay behind that. And now I am close to retirement, and I'm pleased to report that I have achieved that objective. Now, to do that, I've achieved that through only 3 property purchases. all of them within the last 20 years. But those 3 properties between them have 7 income streams. So if you like, 7 different rental units, which gives me some flexibility in the management of those properties. My next tip is to say, where possible, manage it yourself. Because in my experience, you get a better hands-on approach, not just managing the property, but also liaising and managing the tenants. So tip number 2 will be very selective with your choice of tenant, because that's the important formula for me, is to have tenants which are happy to be in your property. In my experience, I've actually got 1 out of 7 tenant who's been with me now for 18 years, 2 out of 7 who's been with me for 16 years, and the shortest term I've had at the moment in my experience with my tenants is approximately 2 years. So that for me is very important, because if you don't get the right tenant, it can lead to all sorts of problems, not just with rent arrears, but also with management of the property and maintenance of the property. So when we buy property, besides the location of the property and the condition of the property, there are 2 major things, and I think Hamish has already touched on both of those. One is the potential yield that you're looking to achieve, and at the moment, a typical Auckland rental property will give you something like 2.5 to 3% gross yield. Doesn't seem very much, but it's certainly on a par with what you can hope to achieve out of a bank deposit. The second point, and again touched on by Hamish, is the potential capital gain. Now, in my experience, those 2 points, the potential yield and the potential capital gain, are almost non-exclusive. You can get much better yields in areas outside of Auckland, but my question for most people would be, can you get the quality of tenant and the tenure? In other words, try and achieve properties which are rented out for at least 50 weeks of the year. And in some areas, that's very difficult to achieve. So those are my tips for property investment, and I'll pass over to the next person, to Neil. Thank you.
Hi everybody, I'm Neil. So I've been in the market not as long as Les, but for about 5 years now with my dad and my wife. We kind of have a team thing going, so we split some properties across myself, my dad, myself and my wife. Anyway, so I've got a slightly different take on properties. I'm more into diversifying across New Zealand. So we initially started off in Auckland and then realized that it was getting quite hard to get the same yields that you can get across the different cities. The other benefit, of course, to diversifying is that you're lowering your risk. Putting all your eggs in one basket can sometimes be unnerving for some people. A lot of people are comfortable with it, but myself, being quite young, just starting a family and things, I thought it'd be better off to split across the country. So the other thing too with diversifying, I guess, is you protect yourself from things like natural disasters. If you had all your properties in, I don't know, say the North Shore, for example, and there was an earthquake and it took all your properties out at once, which is possible, not likely, possible. You could split. You could avoid that risk and move across different cities. So I've got a few in Hamilton, one in Gisborne, and a few in Auckland, and I'm looking to keep buying across different cities as I go over time. So that's the plan. The other thing too is when you get new governments that come in and start making up new policies about capital gains tax and all this other stuff. The one that bothers me the most is the negative gearing thing, and if you're buying in Auckland, you're most likely negatively gearing yourself. I'm hoping to gain on capital gains, but if Labour comes in, which I don't think they have yet, but if they do and they put that policy in place, that could severely impact your cash flow. So that's the other thing. I look for high yields, so we keep that cash coming in, and then we're unaffected by political agendas. The downsides to diversifying, is that there's a lot more in it in managing the property. It's hard to manage it yourself. It's near impossible, in fact, if it's at a different city. So you'd have to get a property manager. And getting a property manager isn't all bad. It does cost a bit of money, but so long as you keep that communication line open between yourself and your property manager, you can, iron out all the kinks with getting the right tenants in and managing issues that come across. The most common ones for me are broken ovens and dishwashers and, leaky roofs and stuff. So it's just a matter of working through with your property manager. And we've been through, on the same property, we've been through about 3 property managers on one of them, because one of them wasn't so good, and then we had to, until we got to the point where we were comfortable. So it is a bit difficult, I guess. That's just one of the downsides. I think there's more positives than negatives. So the other negative, of course, which is obvious, is lower rewards. So you stand to gain less in terms of capital growth, but your risk, again, to compensate is a lot lower. The upsides. So my plan is to buy a house every year, as much as I can for the next 20 years. I'm about 30 years away from retirement, so even if I do one house every 3 years, I'll have about 10 houses when I come to retire. So if I were to sell off 5 of those houses, and assuming that historical trends still stand true in 20 years, and we have property values doubling, every 10 years, then at worst case scenario, I have 10 houses 30 years from now, and they've all doubled in value. I can sell off 5 of them and live off the passive income. So I'm in a good position because I'm still quite young, so I can work on the quantity thing, buying a lot of small properties. So that's So for those of you a lot younger out there that have the time, it's one strategy that you could employ. So yeah, that's me.
Richard.
Hi, I am Richard Prasad. I've been in property and people business for last 30 years almost. I've been selling real estate for close to 26 years and investing into properties for the last 30 years. Over the years, I've collected heaps of properties and made huge dollars through the properties investing. My first experience late or mid 80s when I have approached Hamish's dad. He was a branch manager at Westpac, Kai Road, and together we've done a lot of business. I mean, my first property, which I purchased, was 53,000. I borrowed about 40,000, and the property is probably worth now 750, close to $1 million. And the way I operate business, I buy right, has to be really real good buy, hard buy. When I'm dealing with properties, I'll buy, I'll invest, I will tidy up as much as I can, and at the same time I will add some value. So when we go looking for the tenants, we'll probably get a quality tenant who may last 10 to 15, 18, 20 years, a tenant, where there will be less. At the same time, by doing tidying up property means it has to be done a good job. That adds the value. So in 6 to 12 months time, you can revalue the property, which will give a buyer to buy another property, because that will have enough equity